5 ways rich people invest in a bear market. Investing is a lot more complicated than just buying and holding stocks, and in a bear market, it's even much more complicated. While bear markets might be volatile and come with a general decline, rich people sometimes profit from this. How? Welcome to Investor Info. Before we get into the video, don't forget to subscribe to the channel and click on the notification bell to get notified whenever we upload a new video. Before we begin, let's understand what a bear market is. So, what is a bear market? A bear market is a period of declining prices when the stock market and other financial markets are experiencing a general decline. This can be caused by things such as an economic recession or even war. Bear markets are characterized by low volume, as investors who want to avoid losses will keep their funds off the market. Bear markets are also characterized by high volatility, making it difficult for investors to predict how prices will move. Bear markets can be short-term or long-term, depending on how long the prices stay low. A short-term bear market can last from days to weeks, while a long-term bear market may last months or years. Bear markets can be suitable for investors because it means that people who bought in at the beginning of the bear market are now selling their stocks at a loss, but they have already made money on their original investments. Bear markets also happen to be great for short-term traders who want to make fast profits on small investments and have less than a year or two to wait before they can cash out and get paid back for all their time and effort spent trading. Now, as you may know, a bear market usually comes with some consequences. Let's talk about its effects on investors. What are the effects of a bear market? A bear market's effects vary depending on how long and far the price falls. A short-term effect is an increase in volatility. A bear market tends to cause panic among investors, with many people selling their holdings at lower prices and not buying back in until the price has returned to a level where they feel comfortable holding their assets. This can create a downward spiral for the market, as investors sell out of fear that they won't be able to get back in again at profitable prices. A long-term effect is that people who buy during a bear market have less money than they would have had if they'd waited until things picked up again. In addition to causing emotional distress among investors, it also depletes liquidity in the market, making it difficult for new buyers to enter and existing ones to exit positions without losing money on each transaction. However, rich people tend to be risk takers, and as a result, they have certain options for investing during bear market that brings them profit. Ways rich people invest in a bear market. There are some ways that rich people invest in the market. Number 1, buy and hold, investing and buying low and selling high. In this strategy, you buy a stock once its price hits a certain level. You keep doing this until the price goes up or down by at least your desired amount. This means that your investment is tied to the company's long-term health, which means that if the company does well, you'll do well too. However, if it does poorly, then so will your investment. This can be risky because even though the stock price may go up over time due to positive news about the company, any significant changes in leadership or other factors could cause it to go down again later. Buying low and selling high involves less risk than buy and hold, but since there's no guarantee of success, it requires more effort and research and being willing to sell at the right time, which may not be possible if you have a large amount invested. Buying low and selling high is a strategy many wealthy investors use to get ahead during bear markets. They buy low-priced stocks and industries that they know will do well, then sell them once they've increased in value. The key to this strategy is being able to time it properly. You have to know precisely when your stocks will increase in value so you can cash out before anyone else does. Number 2, they invest in low-priced, low-yield assets and diversify. The rich invest in low-priced assets like bonds, which offer higher yields than stocks. These investments typically pay out less than 3% per year, but they're still profitable because they tend to increase in value over time. While buying a bond won't make you any money if interest rates go up significantly or if inflation goes wild, it will keep you afloat during a bear market. if things start looking bleak for stocks and bonds alike, which is why many investors prefer this type of investment. The rich have access to more capital than others because they can spend less money on things like rent or food, so they have more money left over for investing. This can result in cheaper investments than those available to other people because the rich tend to buy low-yield assets such as stocks and bonds rather than high-yield assets like real estate or business ventures that require a large amount of capital up front but pay very little interest until they are sold at some point in the future. Diversification means having investments spread across different asset classes, such as stocks and bonds, so that if one type of asset loses value, you won't lose too much money overall, because your overall portfolio isn't dependent on just one type of investment. Rich people have more options when investing their money, which means they are less likely to be affected by a single investment's failure. If a stock goes down, rich people can simply sell other stocks and keep their losses at a minimum. Number 3, they buy shares in an index fund and use option trading strategies. Index funds are essentially a way to invest in a basket of stocks without buying each stock individually. The idea is that when a stock falls in price, you don't lose as much money because your shares will be worth more than before. This fund invests in large companies that comprise an entire market index, such as the S&P 500 or Dow Jones Industrial Average. Index funds are typically less volatile than individual stocks because they tend to be more diversified and less risky than individual companies. For example, if you buy a stock that drops 2%, it might seem bad because you lost 2% of your investment. But buying into an index fund means that instead of investing directly in one company or industry, you invest in every company that makes up that industry. So if one drops 2% or 30%, your whole portfolio doesn't suffer as much. Options trading is a way for rich people to invest in a bear market. This is because options are contracts that give you the right, but not the obligation, to buy or sell a security at a specified price within a given period. They're highly suited for bear markets since they allow investors to profit from falling prices. Option traders use these strategies when confident the stock market will fall. They make their bets by purchasing call options and selling puts. Call options entitle investors to buy stocks at a fixed price sometime in the future, while puts entitle them to sell shares at a fixed price sometime in the future. These two types of options represent different ways of profiting when stocks fall in value. Options trading strategies are based on the idea that if you can predict that a particular stock or ETF will go up in price, you should buy it before it goes down. When you do this, you're betting that the price will go up. If your prediction is correct, you'll make money. If not, you lose money. This kind of investing works well during bear markets because prices tend to decline when there's a lot of volatility in the market. The more volatile something is, the more likely it is to change direction quickly and violently, and therefore change its value significantly over time. This means that when buying options on stocks or ETFs that have been seeing significant declines in price, or any other asset for that matter, there's more potential for making money than losing it. Number 4, investing in alternative assets. Alternative assets are basically anything that isn't a traditional stock or bond. Things like commodities, real estate, collectibles, and even cryptocurrencies like Bitcoin. In a bear market, when stocks are dropping and bonds are getting hammered, these alternative assets offer a safe haven. They aren't as volatile as stocks or bonds, so they're less likely to go down with the ship when times get tough. And they're also often lucrative. In fact, they're often more profitable than stocks or bonds. They also use these types of investments as a way to diversify their overall investment portfolio. Number 5, leverage and DCA. Rich people can borrow money from banks or other institutions, which allows them to invest in even more assets than they could otherwise afford. And with much less personal risk, rich people can use the money they've saved to make more money. For example, if you have $10 million saved, you can borrow $200 million from the bank and buy stocks. If the market goes down, you'll be able to sell off your stocks at a lower price than you paid and then pay back the loan with interest. You'll earn money on your investments because of this leverage effect. Another strategy rich people use is dollar cost averaging, DCA. DCA means buying more shares each month instead of just one big purchase at once, which could lead to making a mistake because sometimes prices may change significantly between one month and another depending on how much time passes between these purchases. Many investors don't know how to handle this situation, so it's not surprising that many investors panic and sell their assets because they've lost faith in their investment strategy. But what if there were some tips out there on how to survive in a bear market without losing everything? Well, there are. Tips for investors in a bear market. Number 1, don't panic. Bear markets are stressful, but they're also a time for investors to be creative and learn about their investments. This is a chance to evaluate your portfolio and find better performing stocks or sectors. The best thing to do is accept them for what they are, a part of life, and use them as an opportunity to find new ways to grow your wealth. Number 2, stay focused on long-term goals and objectives. A bear market is a time of uncertainty, and looking at short-term gains in the stock market is tempting. But remember that it takes time for short-term gains to translate into long-term growth and profits. The point of investing in long-term growth and that it takes time. If you're worried about losing money during the current market downturn, don't make rash decisions about selling your investments just because the market has gone down in recent months or years. Instead, stick with what's working for you and focus on making sure your portfolio remains diversified and balanced over time so that when the market rebounds again, your investment strategy will be ready to ride it out with you. Number 3, focus on the fundamentals. The best way to invest during a bear market is to focus on the fundamentals of your investment strategy, rather than trying to time the market by trying to predict when the bull run will end. Suppose you're focused on what's happening at any given point, rather than what's going on in the world. In that case, you'll be able to keep your portfolio profitable regardless of what's happening with the stock market or other investments. Number 4, diversify. Diversification is essential when it comes to invest during a bear market because it helps reduce risk, keeps your portfolio from becoming too risky overall, and protects against losses if one investment goes sour or if something unexpected happens. Number 5, set realistic expectations for your investment portfolio. Just because your stock portfolio has dropped 30% doesn't mean that you should completely abandon your long-term strategy. You still have plenty of room for error before you need to worry about cutting distributions or selling off assets entirely, which could cause more damage than good. And remember, the goal isn't to make money from this particular bear market, it's about building wealth over time, so that when things turn around, you won't have anything left to lose. It's easy to get caught up in the excitement of making money, however, it's still necessary to consider some factors before choosing to invest in a bear market. What you should consider before investing in a bear market. Number 1, the investment climate. Bear markets often happen when there is an economic downturn or a financial crisis, so it's essential to understand what caused the downturn and whether that situation could happen again. Number 2, your goals. What are your long-term goals? If you want to retire one day and don't have much money saved up, then perhaps this isn't the best time to invest because you won't be able to get as much money back out of your investments as you would if they were working for you right now, which may mean making some tough choices. Number 3, your risk tolerance. Bear markets often come with higher risks than bull markets do because people tend not to expect them as often, or at all. So it's essential for those who have low risk tolerance levels and are low liquid savings accounts not to invest until they feel more comfortable because there will be plenty of opportunities. Number 4, inflation rate. Bear markets can be accompanied by high inflation, which means that prices rise much faster than they would typically do in a normal market, which makes it harder for people who rely on their income from investments to stay afloat during these times. Therefore, it's essential to keep track of inflation rates with regularity so that you can make adjustments accordingly if needed. For example, if inflation rises too fast, consider shifting some of your investments into bonds. Finally, always remember that investing is not about making money from capital gains alone. It's about building wealth over time by managing your investments wisely so that you can build wealth. Hopefully this video has given you the insight you need on ways rich people invest in a bear market and how you can utilize them. We have come to the end of this video. Thanks for taking the time to watch. Kindly leave a like if you found this video helpful, and drop a comment in the comments section if you want to let us know anything. Please subscribe to Investor Info and check out our channel for more videos like this one.